everyone, thank you very much for attending the 2022 and Beyond webinar. We're going to go through a few things. For those of you who don't know who Swiss is and what we do, we're a financial services company. We have many, many partnerships, many product providers. You might know me and Viv from TV, or radio. We do a lot of different channels. Essentially, what we supply to clients is we started as a stockbroking company. Online trading, you guys, it's pretty self-explanatory. You're taking control of your own money, and you're really just using us as the route into different markets. So whether you're going and buying an MTN share on the JSE, or you're buying a Tesla share on the Nasdaq, that's how you can use us for execution. We kind of bulk all that flow up at the product providers and get very, very good prices. And that's kind of the idea behind that business. It's a volume business. We just want as much flow as we can, so that it helps to bring down the cost on all the other products as well. So private broking, that's a little bit more the old school service. So that's where people phone in. Maybe you want research, or these days it's WhatsApp. You've got a personal dealer. You've got someone that you can chat to. We source research for you. You get kind of higher grade research as well. It's a lot more high touch service that we offer. It's great for people that still want to control the ultimate decision. They want to tell when, they want to be the one controlling when we buy or sell a security or an investment for them. But they want someone to explain the investment case behind the stock. They want to go through the technicals, go through the fundamentals. They want to look at what research that the decision is based on. Obviously, online trading these days we can do for incredibly low cost. But with the so obviously incredibly low cost online trading at the moment, but private broking, we need a slightly larger capital deposit just to make it worth our while. In terms of managed portfolios, we have this is now a discretionary service. So with a discretionary service, instead of you making the decision to buy or sell, we make that decision on your behalf. And the way that we found works best, we can create bespoke discretionary products where we handle things, but given the volume of clients that we're dealing with, it's far, far simpler for us to run model portfolios. And we run a number of model portfolios, the most popular of which are overseas. Most of our assets sit are South African investors investing internationally. And those managed portfolios really are are a fantastic way for people to access the market if you don't have the expertise to kind of make the underlying buy and sell decisions yourself. We then have structured products. This is a much wider universe of products. It's not limited just to the equity markets. We have wonderful partnerships out of Switzerland and locally as well, with Absa and Investec, just to name a few. We've actually, I'm going to chat about a Sunland product today as well in the structured product section. But really, really solid products if you're looking for something that is, not equity, but not quite a bond. It's a lovely little hybrid product if you can get it right. Offshore transfers, self-explanatory. This really facilitates so much of the business that we do, and it's really just to make your lives easier. So, if we're investing on the US exchanges or the UK exchanges, we can then handle the actual transaction flow backwards and forwards. And that transaction flow, we can do at lower cost for you because it's not a primary business. We're not just trying to make money on the offshore transfer like a bank would, or like specialist transfer agents would. We're really doing it just to support your investment journey. And then finally, our wealth management and tax-free savings, the last two products. Wealth management is really the advice. It's looking at retirement planning. It's a far more in-depth relationship that you set up with your broker. In a wealth management relationship, we're doing a full needs analysis for you. We're looking at what your income is, what your expenses are, how much time do you have to requirement, and we really tailor the recommendation for you specifically as a person. The difference between that and a managed portfolio is a managed portfolio is only going to be suitable for a specific risk profile. So if the portfolio is a high risk portfolio and you suit that, it's going to be our best high risk ideas inside that, but it will be a high risk portfolio. Tax-free savings accounts, pretty self-explanatory. This is kind of a bonus product that we do for clients. We don't actually, we've cut the costs absolutely to the bone, and we kind of run it as almost like a pro bono work for our client base. If you have if you have a product with Swiss, so if you've got a managed portfolio, if you're one of our online trading clients, if if we're handling your RA or anything like that, you're welcome to use our tax-free savings account for free. It's fully managed, and I'll chat a little bit about the strategy behind that in a moment. So what are we talking about today? So the topic today, okay, first we're going to do the year in review. You guys are all here to hear what is going to happen in 2022. We're going to gaze deeply into our crystal ball and try and work out exactly what is happening in the world. Very difficult ask, but before we do that, we're just going to have a look at what we said last year. So 2 years ago, we flagged in the Black Swan section that potentially there could be some sort of outbreak in China, and it turned out we had COVID. So sometimes we get it right, sometimes we get it wrong. We're going to go look at the scorecard, if you want to put it that way. Viv's then going to take you through 25 binary questions, and you'll see that the last year we had some quite fuzzy questions. So this year we've tried to make them quite definitive, that there is a yes and no answer only. Viv will take you through, and obviously each question he's going to talk around our themes, our big themes that we are seeing in financial markets and global economics, and how they could potentially impact you as an investor. You'll hand back to me. I'm going to do the practical application, so how to take, Viv is essentially an analyst, so how to take his analytical work and distill that down to practical, actionable ideas that you can make either in the local markets or the offshore markets. And then, of course, we're going to do a little prize giving. So we've got all the entries from last year, and we've got a couple of prizes. I don't know if you can see it at the moment, but we've got a couple of prizes that we're going to hand out, and we'll arrange for that. And then, as I said, we're going to stay on for Q&A for as long as is required. So first, let's look at the year in review, what Swiss got wrong and what Swiss got right. So before we get to that, I think one of the big things that we got right last year is we actually won the Stockbroker Award. So we were the Stockbroker of the Year, topping out likes of Standard Bank, FNB, and some of the big banks, and also some big listed companies. Easy Equities, it was a tough contender as well. So very, very proud of what the guys have done on the desk. I think Viv and I also managed to win the business day stock pick thing. So from a stock picking and from a business point of view, it was a great year. We actually picked up not only the top broker award, but we also picked up the People's Choice Award, which is voted by you guys, our clients, which we're always incredibly grateful for the support. And we also picked up the top tax-free savings accounts award as well. So looking at it, the year in review. So this is the year in review. The South African Reserve Bank raised interest rates. Okay, so these are the questions that we had in 2021 and how we did on them. I'm going to run through them very quickly because I don't want to kind of focus too much on last year. It was a tough year for predictions, and I think a lot of those red crosses are actually me, so I'm not going to leave them I'm not going to hold Viv to them. But yeah, basically, will the Reserve Bank raise interest rates? We said yes. We did get that last interest rate. Interestingly, the audience, which we track as well, and I'll give you the audience statistics next, most of the audience said that we wouldn't get an interest rate hike, even though it was in line with consensus. SA GDP growth above 5%. Of course, this one also, as I said, the questions were a little fuzzy last year, so we don't actually have the GDP numbers out yet. We're still waiting for the final numbers for 2021. So we've looked at estimates, and the estimates do look like GDP is going to come out above 3.5 because we did get a rebound off a low base. We said we think that there will be a rebound, but we didn't think that high. So I've marked it wrong. We'll actually find out that might actually flip to right when the official numbers come out. Will SARB tighten exchange controls? We said no, maybe a little bit of procedural stuff, but nothing official, if you want to put it that way. Bonus, okay, then we had a whole lot of bonus questions. We normally do 25 questions. We added a whole lot of extras. Will the ANC regain true control of Joburg and Pretoria? We said no. Will the government attempt prescribed assets? Now, again, this year we're trying to make it very binary. Viv was handling this question last year. I actually watched the presentation, and he kind of said no, he doesn't think it's going to happen next year, but he does think that there will be some actionable moves going through on prescribed assets. So we've kind of like taken a very gray area, and again, we've marked ourselves down. I've tried to mark as strictly as possible for us anyway. Will the USD average between average above 1550? The correct answer was no. We said yes, we do think it is, and I was using a Wells Fargo estimate where they were looking at about 1625. Interestingly, the average rand-dollar exchange rate over the last year was 1480, and it was that big strengthening with the resources early in the year that helped that out. If we had taken a 2-year view, just to show how different it can be, if we take a 2-year view, taking into account the big spike out that we saw in 2020, the average would have been 1564. So would have been right on a 2-year view, but was wrong on a 1-year view. Currency incredibly difficult to predict. We've got another currency question for this year, so yeah, I think it's going to be an interesting one. Then will there be more listed companies on our exchange? It was kind of an easy one. The trend on deregulation is quite clear. At least the delistings is quite clear. We had 139 companies registered on the exchange in December 2020. And at today, 2021, we have 325. So we have dropped off. We've seen a few more delistings, so that trend is continuing. Got that one right, an easier one. So interestingly, which was the best performing local sector? Now, telecommunication is the right answer. I gave 2 last year because it felt to me to try and make the prediction. I said the safe bet was the industrial index, but I said I just have a gut feel that property is going to rebound, even though we're in such a poor place in terms of what is happening in local property. So just to run you through the numbers quickly, property actually did just under 30%, the South African property index. Food and drug retail was up 21.85%. Resources were the big laggard, only up 13.42%. Industrials, the safe bet, beat the average, only up 16.5%. Banks, I think with a big rocketing move that we saw in Capitec, up around 34%. Life insurers, both life insurers and non-life insurers, underperforming dramatically. So life insurers only up 12.38%, non-life insurers essentially flat for the year. And the winning sector, telecommunications, up a whopping 72.98% from the last webinar, or actually from today backwards 1 year. So incredible gains there. Lots of it coming from MTN, Telkom, all doing exceptionally well in the post-COVID world. Will small caps outperform large caps? Yes, small cap index absolutely smashed the large cap index. And a lot of that, I think, was, we got that wrong. We said stick with the larger caps. A lot of that was Naspers pulling back. So Naspers obviously down 20%. We were quite constructive on China last year, got that call unfortunately out. Will the all-share index beat the MSCI World? We were also constructive on international stocks last year. All-share index did not beat the MSCI World. Will Biden be president in January? Yes, we said Biden would be president. We did make a qualifier saying he's a pretty old guy, and we might actually have Kamala Harris as a president, but I think I have a 25% chance that might happen. We obviously still do have Biden as president. Social media, we didn't see coordinated regulation. Another gray one, Chinese-US trade war, has it ended? No, we haven't seen tariff barriers dropping. It's certainly simmered down. Viv was talking about it moving towards more of a Cold War last year. Bonus, peace in the Middle East, yes, we're calling that as a yes. Well, again, a fuzzy one. I kind of marked all the, I just gave whether you answered yes or no to this in last year's survey, you got a point because it was a bit fuzzy. Will the Nasdaq end higher? Now, this was my fault. I said, listen, I think the Nasdaq is hellishly expensive. I think some of those big Zoom stock, like stocks like Zoom and the work from home stocks are going to crumble. I thought it would be pulled down. I didn't take into account what happened in Tesla. I said, I'm going out on a limb, and I said, I think Nasdaq is overpriced and we might see it lower. Obviously, we had another rocketing year for the Nasdaq, so I was incorrect in my call there. I said that we had got equal weight tech in the portfolio, which we have. Will EM beat DM? I showed you a chart of like basically long-term trends. I said very difficult over 1 year, but I said I'll go out on a limb and say no. Also got that wrong. EM did underperform developed markets. Again, our money is sitting in developed markets. So I'm very happy because we got the returns, but kind of my more speculative call that we'll see the turn sooner. Still believe that we will see the turn, but not quite yet. Will oil prices be below $55 a barrel on the 31st of December? Obviously, well above that. We went through the OPEC forecasts last year, and oil prices have spiked. Got that one right. Back to home versus work stocks. Interestingly, if you look at what's happened there, I took a little composite of the index. You know, it's difficult to say because it depends what you're doing. But if you look at something like Royal Caribbean up 12%, if you look at Zoom down 47%. So those overpriced tech stocks did come down pretty aggressively. Will the world achieve herd immunity? We've called that a no. Will the Olympics take place? We said no, it's a complex event and it did actually happen. Will lockdowns end in the developed world? No. We said yes, maybe in the developed world, but not in South Africa. We got the South African one. Developed world lockdowns are still happening. We saw them with the Omicron variant. Will Zoom outperform the S&P 500? As I said, Zoom down 47%, S&P 500 up 24% for the year in dollars. So very, very strong there. We see autonomous cars. This was our tech section, our future tech. We talked about all the themes that are going to be playing out. And we didn't see autonomous cars at level 5 autonomy yet. We didn't see AI write a hit song, not that I know about anyway. Difficult to go find that one out. And will GPT-4 pass the Turing test? GPT-4 not yet at that level. Will Blue Origin launch a crew in 2021, a man's flight to space? I said yes, because we all saw that rocket with Jeff Bezos actually in the rocket last year. We said yes. I'm giving us the point. Viv has some dispute over whether it actually went to space or not. Will Neuralink implant in a human brain? Not quite yet. It's not there. We thought maybe, you know, in some form it could have. So that was our thing. So how did the scores do? We got 66% of the questions right. It was a difficult year. And like I said, we marked aggressively. Audience got 61% in aggregate. The top forecaster only got 73%. So you can see obviously a difficult set of questions last year. Now, if you are interested in doing the questions, I've got the link up on the screen. I'm going to put it in the bottom right-hand corner for the duration of the presentation. So, well, not the duration, but for a lot of the slides, it's in the bottom right-hand corner. You can go there. All the questions for this year that Viv is about to take you through are up. Mostly yes or no questions. Fill in your name and email address and phone number if you want to be eligible for nice gift baskets. I don't know what we'll do next year. It depends how well the company does. Maybe the prizes will be nicer than gift baskets. But it's, yeah, fill it in. We haven't like officially given you the prize, but yeah, basically ranswiss.com/events beyond 2022. Put in your picks. Once you complete that, you'll be eligible for next year's prizes and you could be crowned the top forecaster. The actual top forecaster, I'm going to reveal at the end of the presentation. But with that, Viv, over to you. We've got 25 questions, and I think your first question is, will COVID restrictions end this year?
Thank you very much. I see there's a question here. Okay. Okay, we'll come to that near the end. Okay, so with regards to COVID restrictions, sorry, can you hear me fine? That's cool. I do think that we are seeing, you know, cases rise, but the lethality has gone down dramatically. This is a thing we see in most viruses, in most infections, most pandemics, going on long enough, that actually over time the virus does, or the infection does tend to become less deadly or less, you know, harmful to people. This is an evolution that viruses undergo. It's always in one direction. I mean, we do have things popping up again and become more deadly, but generally we would have anticipated that there's a chance of this happening. Omicron basically is much more contagious, but much less deadly. And then we are seeing that obviously coming through with regards to, you know, deaths and hospitalizations and so on. That being said, because of the political situation globally, I don't think we'll see restrictions entirely end. We've seen basically the Prime Minister of the UK, sorry, of Canada, Justin Trudeau, come out and basically say that he's going to make life much tougher for unvaccinated. Montreal or Quebec, sorry, rather, has pushed through the possibility of putting increased taxes on the unvaccinated. The French are also looking at stuff like that. So I think the political situation, because of the way, you know, these kind of things align, will make it quite difficult for you people to just basically get back to normal this year. Next, these are the economic questions that I think are going to be key for the next year or so. The first one, probably the most important one, is will US inflation measured by CPI move below 4.5%? As Gary mentioned, some of the questions we had previously have been a little too vague. So now we see inflation, and what inflation we're looking at. We're looking at the CPI number. 4.5% is, above the long-term trend for the US, economy. At 4.5%, you need to have interest rates above 4.5%. You have real interest rates being positive. Real interest rates being the difference between the interest rates given to you by the bank and the actual inflation rate. So you take interest rate minus inflation rate, and you get real interest rates. And if we don't see it below 4.5, it's significantly above, the normal trend, and definitely would qualify as inflation not being transitory. We personally think that it won't happen this year. We might, I would think the average for the year will probably be about 4.5. Will the Eurozone GDP growth rate beat the US growth rate? I think it's a possibility. The reason being is that the Eurozone, has a lot of pent-up growth in it at the moment. It has underperformed for the longest time. What we've seen with COVID has also been quite negative for the Eurozone. Expectations are for the Eurozone to be slightly better than the US for 2022. Will SA GDP be above 2.5%? Okay, current estimates are between 2 and 3% for the year. 2.5%, I think maybe not. I know we were overly pessimistic last year, but I continue to be pessimistic. The reason being is quite simple. We have a strong bottleneck on our economy. We can't grow faster than we can provide electricity. And right now, the electricity supply in the country remains very uncertain, very dependent on what happens at ESCOM. ESCOM has shown itself to be incredibly, incompetent with regards to providing electricity in the country. All deadlines we've ever seen with regards to new power plants coming online, or et cetera, have been blown away. So I don't think that's going to be a possibility. Will the SA unemployment rate drop below 35%? This is the official unemployment rate. Last time I checked, it was just under 35% at 34.9, I believe it was. I think we will see that trend continuing to head worse. Unfortunately, what's happening right now in the South African economy is, even though there are sectors that are reasonably comfortable with regards to, employment and wages and so on, many sectors are under a huge amount of pressure at the moment. Tourism was really hit quite badly by Omicron. The industrial sector, of course, is under huge pressure because of what's happening with the electricity supply. Mining, I think there is going to be a recovery in commodity prices that might be good for mining. Unfortunately, over the last, several decades, or fortunately, depending on how you view these things, we've gone towards a more mechanized, approach to mining. The number of people employed in the sector has not increased dramatically. We're looking more towards, using machines and using people. Obviously, mining is not a good job for the majority of the people of the world, of the country, sorry. Very dangerous, bad for your health. If you don't die in a mine accident, just the environment itself is going to probably harm your health. And so obviously that's something we should be thinking about. But with regards to the sector absorbing a lot of labor, not really likely. So I don't think we're going to reverse that trend. Even though that was boosted up by COVID, I think the trend is still going to continue worse for the unemployment rate for South Africa. And next, will the MSCI World earnings growth exceed 10%? And I think there's a chance of that happening. That we are going to be seeing a lot of pressure coming into the world with regards to interest rates increasing, that kind of stuff. But when you look at forecasts for growth, the US is looking close to 4, the EU above 4%, China above 5, places like India above 7. The world is still going to grow reasonably fast, above trend line for 2022. And that probably is going to translate to an even higher growth rate for earnings globally. Okay, now let's bring this more into a slightly more practical aspect. What is the outlook for currencies? The first one I put up there was the Turkish Lira. For those that don't know, Turkey has had one of the worst performing currencies, if not the worst performing currencies, over the last few years. Their president basically has decided that he knows literally more about economics than any economist that's ever lived. He's basically thinking that if you cut interest rates, you will cut inflation and you'll boost your currency, which is the exact opposite of what most economists would say. It's like saying, turn the steering wheel to the right and your car will turn left. That's what he's kind of saying. He's tried this for the last 5 years or so. Whenever a central bank governor gets into power, and doesn't basically follow this crazy rule, he fires them. And that's moved that currency from about 3 lira per dollar 6 years ago to above 15, I think, at one point in time, the last month or so. Currently about mid-teens to the dollar. To give you an idea, it would be like us going from about, say, 15.50, well, say 15 to the US dollar right now in 2022 to about 75, 80 to the dollar in basically 6 years' time. 80, by the way. That's what's happened. And this is a huge economy. This is an economy twice the size of South Africa. Massive amount of people. It's a very, very big player in the global economy. And the question is whether or not it's going to get below 12. I think there's a possibility. The Turks do crazy things sometimes, but they generally have a strong bureaucratic kind of net that kind of brings things into play. Erdogan has weakened that. In the past, we have seen, for instance, before Erdogan came to power, regular coups by the military to make sure that any politician that got out of line too far was evicted, and someone more sensible is put into place, in inverted commas. Erdogan has removed some of that power, but I still think that the underlying structure of the Turkish economy will not allow this kind of craziness to continue too much longer, and we could easily see the currency strengthen if Erdogan is removed. Will the rand US dollar round rate finish above 16 to the dollar for this year? I suspect not. I think that the trend since about 1994 has been about 6% per year weakening. With COVID, a couple of years ago, we basically went crazy and broke like 19 for a little brief patch. We've kind of gotten more towards the normal levels over the last little while. We had a blowout, middle of last year with like the riots and stuff, and then we had a couple other factors like Omicron coming into play that increased the currencies or decreased the currency's value versus the US dollar. But I do think that we will probably go towards that trend line longer term. So we probably will be a little stronger than that at the moment. Will the Fed hike rates more than 3 times in 2022? I think that's quite possible. I mean, we're looking at the assumptions that were in the market. There were 2-3 times hikes predicted. And then the Fed comes out and says, we're going to be more aggressive than you think. Pretty much saying that, they were probably going to hike, 3 to 4 times maybe. So I think 3 times plus is probably quite likely in 2022. And will the SARB raise rates by more than 2% this year? I think, there's a chance of that happening, but I would suspect not. Our growth rates are going to be reasonably low, and we will follow the Fed. We probably won't be too much more aggressive than they are, especially if inflation in South Africa, which surprisingly has not been as badly affected as some of the other places in the world relative to their inflation bandwidth. So if you look at the band for the US, they're far beyond that. We are not that far away from the US actual number, but in terms of our band, we are still well within our band. So raising interest rates when we might not see that much growth coming through might be a difficult thing. So I think the South African Reserve Bank might be a bit more cautious around this, especially with some of the pressure from our politicians about keeping rates low for longer. Okay, here's some commodity forecasts. Will the gold price finish above 2,000? I think there's a chance. With any uncertainty, with any difficulty out there, the gold price will tend to rise unless there's some kind of thing like the debt crisis in 2008, where you found gold under pressure as well. But generally, places like China, places like India do like to invest in gold, and so I do think there's a strong possibility we could see gold above 2,000. It hasn't done that much except for the brief flipper about a year plus ago. Currently about 1,900. I think we could see gold above 2,000, especially if people are looking for safe havens. If the market comes under pressure because of high interest rates, if people are a bit more afraid but not terrified. I mean, gold does reasonably well when people are slightly afraid. It does not that well when people are very afraid. That's kind of it's a Goldilocks thing. But yeah, if people get a bit more nervous about interest rates, inflation, and so on, you might see gold rise above 2,000. I think that's a strong possibility. Will Bitcoin break 100,000? I think there's a chance of that happening. Again, Bitcoin right now is sitting at about 40. It would be a huge leap up to go to above 100,000. It's a possibility. But if you had to take a bet right now as to what's going to happen, I would suspect not above 100,000 this year. I think Bitcoin basically is coming to a point where we are going to see all of these cryptos under a bit of pressure. There has been a huge flood of liquidity, especially to people that are not normally in the financial system, as investors and so on over the last couple of years. People always go back to 2008 and say, hey, the market is flooded with money, and why didn't we have inflation? Why didn't we have all these things that you're worried about right now? The difference between then and now is this. In 2008, what happened was the government put money into the banks' hands. The banks weren't lending it out to people. In 2020, 21, what happened is the government was literally giving people checks. It was saying, here is a check in your hands and spend it as you want. Some of these people basically may have paid up medical aid bills or bought their kids' shoes, but some of these people went and bought NFTs and bought Bitcoin and went and basically, played the stock market and got GameStop stocks and shorts and blah, blah, blah. So much of what we've seen right now over the last couple of years has been fueled by this kind of money in the hands of people that, weren't normally given money by the government, discretionary money like this. And this may explain some of the stuff that we've seen over the last couple of years. So I think all the cryptos are probably going to find some pressure in 2022. So I suspect this is not going to be happening. Okay, so no for the 100,000. Will platinum head above 1,200? Unfortunately not. The car market will remain constrained. We've seen new car sales under pressure. Without new car sales, platinum is going to be under pressure. And platinum could include all the platinum group metals. You need, the catalytic converters in cars as a core demand for platinum to get the prices higher. So I suspect not there. Will Brent crude oil break $100 this year? I suspect, unfortunately, yes. There is a lot of, uncertainty around places that produce a lot of oil. Russia, Iran, those places are big chunks of global production. That could be, things driving it up. Also, looking at the break even for their budgets, even at $80 a barrel, quite a number of places, like places like Nigeria and so on, don't quite break even in terms of their budgets with oil prices that low. Oil prices, back in 2008 went well above $100 a barrel. And I suspect that might be a trend happening going forward. And also one of the big factors that has taken away, one of the big factors that was keeping a kind of a lid on oil prices was the US, shale production, which to a certain extent has diminished. It's not entirely policy-based, it's an approach and attitude change. A lot of these places in the past used to basically, oil prices go above, say, $70 a barrel. I can make oil at, say, $40 a barrel. I'm just gonna make more oil. Now, that means that increased the production, that brought prices down, and your profits went down. So I think the shale industry has kind of learned its lesson about overproducing when prices are a little higher, especially because those price increases might be temporary. So now they're more concerned about returning returns to their shareholders as opposed to reinvesting in production. Combine that with the Biden administration, kind of attitude against shale production, and that has led a bit of a negative tinge to the US shale industry. And I don't think it's going to have the power it had in the past to actually increase production as needed when prices rise. So $100 a barrel oil, that's Brent crude oil, by the way, is reasonable. Okay, now we get to the actual, coal face. This is the stuff that most people are going to be concerned about. Yes, you can invest in currencies, and yes, you can, invest in commodities, but the majority of you are not going to be looking at commodities or currencies as the bulk of your investment decisions for this year. Most of you are going to invest in stocks, and the most overall aspect of stocks is like, look at which indices we think are going to be the best performing going forward. Will the all share index finish above 8,500? I suspect not. This would be something like a 15, just under 15% increase in the all share, about 15%. I don't know if we'll be able to do that this year, especially if we do see the rand not, weakening dramatically. A lot of our biggest stocks, things like Naspers and Sasson and so on, benefit a lot when the currency is weaker. If we don't see a significant weakening in the currency, it could be a real hampering point for keeping the index higher. Will the S&P 500 and above 5,200? I don't think it'll be a great year for the S&P 500. I'm not saying it will be a crash, but I don't think it's going to be a great year. High interest rates tend to bring down equity prices. So I think that might be a bit of a pressure there as well. Will the Eurostoxx 50 top 4,700? Again, I don't think we're going to see above average returns in the Eurostoxx 50. Will the Chinese 50 index be above 17,500? I think there's a possibility there. China's been under pressure. I think, especially with Xi Jinping basically effectively going to be re-elected this year, he doesn't want to see a negative market. He's probably going to try and boost up the Chinese economy, the Chinese market. Want to have a good window dressing period for that economy. So I think it's probably going to be a better than expected year for China and China stocks. He's kind of cleaned out all those billionaires, people like Jack Ma and so on. He set the rules. He said this is who's in charge, and it might just be a point where he wants to get back into business and trying to make that economy look as strong as it did in the past. Like I said, he's combining with an important year for him. China doesn't have elections, but it has the Chinese Communist Party, and those guys, those cadres, do want to see a positive growth story for the country. So it'll be a good thing for China. Will the Nasdaq outperform the S&P 500 this year? I don't think it will. I do think that the Nasdaq is going to be under more pressure than the S&P 500. Rising interest rates tend to be more negative on companies that have more future growth, because you have a higher discount rate for future growth. Nasdaq is a bit more heavy into that, and therefore you're going to have more pressure on the Nasdaq than you will have on the S&P 500. So I don't think it will outperform. I see some questions coming through, and we'll answer that near the end. Well, I see there's Terence Hill here. I know there's a Bud Spencer as well around. Okay, sorry. Here's some political questions. Okay, will the Democrats lose Congress? I think there's a strong possibility there. This is the US, by the way. Will the Democrats lose the Senate? I think there's a much stronger possibility there. And will Boris Johnson still be Prime Minister? I think there's a chance he won't. Okay, let's go through each of these quickly. The Democrats have a reasonably slim margin in the Congress. Right now, the Democrats have the Congress. They kind of have the Senate, and they have the presidency. When you have those three aligned, you can do more stuff than if you have a split, system. The way the US system works is the Congress does something, then the Senate adds to it, and then the president signs off on it. If one party controls one of those things and the other parties control the other two, there's a kind of like a traffic jam that doesn't allow new legislation to go through. The Democrats have a lead in the Congress, but it's slim. They actually didn't do that well when the last election. There's election this year, the midterm elections, 2022. Current polling suggests a significant loss for the US Democrats. Will they lose the Senate? The Senate is basically 50-50 split. And the US, when they have the 50-50 split, what happens is that the vice president, steps in and provides that deciding vote. Right now, the Democrats have a 50-50 split, and they have the Democratic vice president. And obviously, she steps in and she provides that split vote. And so all they would need to do is lose one seat, and they would basically have lost that house as well. And then Boris Johnson as prime minister. Boris has had a huge hit in popularity. One of the reasons that the Tories have been so powerful over the last couple of years, or so strong the last couple of years, is that the Labour Party, which is the opposition party in the UK, has been run by a guy called Jeremy Corbyn, who is very, very left wing, far too left wing for the citizenry of the UK. That he's been replaced, and that by somebody that's more like a Blair kind of the Blair camp, let me say, more centrist. And I think after the stuff that's happened with the Tories with regards to COVID, the UK does not, or the UK public does not think they handle COVID very well. There's very little belief that what Johnson did was positive. He's also had some missteps, like having events, parties, and so on, while he had lockdown for the country. So I think there's a big chance that he loses out there. Why are these things important? If the Democrats lose the Congress or the Senate, I think it's a very good chance of one of both of those things happening. We can pretty much ignore any future stimulus plan until we get the 2024 election. So those 1.5, 3 trillion kind of plans, Build Back Better, all those kind of things disappear if they basically have a split, Congress, Senate, and presidency. And will Johnson be Prime Minister? I think if he's not Prime Minister and we do have more turmoil in the UK, we could see a further delay in Brexit, which is obviously a big negative for the country. Each new Prime Minister, or especially different parties, will have different approaches to what they really want. There's some serious political decisions that need to be made around Brexit, things like what's in Northern Ireland, fishing rights, etc., etc. The Labour Party is a bit more, Euro-focused than the Tory Party, and that means they want to get more likely to take, rejoin the EU. And if that is the case, there's a possibility that they might try and scupper some of the stuff that's been happening or been already decided by the Tory Party. So Brexit, of course, an issue. I see some things coming through. I will come to that at the end. But I'm seeing you guys here, Sibingile and Colin. So Black Swan events, so things that I do want to put out there as Black Swan events, things that if they do happen will have a huge impact on the globe. Okay, first, will China invade Taiwan? Now, I don't know how much you guys know about this situation, but here it goes. Taiwan, there was a Chinese civil war. The losers of that civil war went to Taiwan, and the winners took China. China thinks Taiwan is part of China, okay, and has argued for the longest time and basically said that it will reunify. Any country or any individual that goes out and says that Taiwan is a country faces Chinese issues. So we will find a situation where if we do see China make moves towards Taiwan, it'd be fulfilling this long-term thing. Obviously, they haven't done it so far. Why? Taiwan has some strong alliances in the area. If Taiwan is taken by China, a place like Japan get really worried. The US is against it. That being said, the Chinese, if you look at any kind of Chinese media, they are far more hostile to the US. There's something called wolf warrior diplomacy. It's based on the idea. There's this movie called The Wolf Warriors, which is it's like Rambo, but for Chinese people. Okay, so like how Rambo fought the Russians and like one man killed 100. It's the Chinese people fighting the Americans and one man kills 100. That's the wolf warrior thing. Anyway, they do believe that their army is a match for the US, especially in their neighborhood. And China and Taiwan are in the same neighborhood. Nothing is close from the US point of view to Taiwan. It would be difficult for them to do something, a conventional army base. So Taiwan could be under pressure. More likely, they're not going to have a military invasion, but they will try and put pressure over time. But that being said, look at what they've done in Hong Kong. The Chinese are not as cautious as they once were with regards to pushing their rights. They're doing the same thing in India as well. There are places in the north of India that they think is theirs, and they've actually started building roads and villages and putting their army right there. And so we are likely to see a more hostile China, but I wouldn't put 100% chance or even like a 50+% chance. But I think if it's something like this does happen, huge issues. Taiwan, a massive part of the world's semiconductor industry is in Taiwan. Also, you get Taiwan being invaded. You have Japan basically thinking, they might have to go nuclear. That changes the way the whole global situation works. It's a huge increase in uncertainty. And if something like that does happen, of course, be concerned. Will Russia invade the Ukraine? How much of the Ukraine? Who knows? But they could invade a part of it. They've already done part of it. Crimea was part of the Ukraine, now invaded by the Russians. So they might make some moves against the Ukraine. Why are they doing this? Because basically the West broke its vow or its word after the end of the Cold War to allow things like, for instance, the reunification of Germany. NATO, which is the Western kind of thing against the Russians, said we won't go towards Russia. We won't go eastwards. So the places that are to the east of Germany, that's yours. We'll take Germany. Since then, they have done stuff like that. They've gotten some of the Eastern European countries to join NATO, and Russia is seeing that encroachment on their territory. And of course, it's Putin's a bit of a strong man, so he wants to show what he can do. You can add actually Kazakhstan in here as well. It's another important possibility that we might see Kazakhstan also, maybe with some Russian dependence. We've seen that already in the last week or so. The Russians have moved some military presence into Kazakhstan. So that is, a possibility as well. So I do think this is more likely than Taiwan. I do think the Russians are going to exert a lot more, military force in the area, because their economy isn't doing great. They have a smaller economy than Italy. Italy isn't a huge economy in Europe. So you can understand that Russia is a tiny economy, but a very powerful military. And so if you're going to look at that situation, you rely on your military, and that's what Russia is going to do. So I think there's a chance there. And next, will China face a full-blown debt crisis? I think it's unlikely this year. That being said, things like Evergrande and so on are indicators that the Chinese really have a serious systematic issue. The Chinese won't let one small thing like Evergrande bring them down, but there's a possibility that if Evergrande occurred, there's other issues in that economy that are also, a problem. The way I put it this way, there's a reason Evergrande happened. It wasn't just Evergrande. It wasn't a rogue company. It was the system in China where, government policy sometimes ignores what's happening with regards to the actual economy. It's a system where connected people can often do things with government approval that doesn't make sense in the normal economy. And that means that there are loans out there that don't make sense from an economic point of view, and those loans won't be repaid. And there's a possibility that it might happen. I don't think it will happen this year. Again, very important year for Xi Jinping. This man is setting himself up to be emperor for life, or leader for life. He basically is trying to follow the Putin model. Run a country, maybe not the best thing for that country, but kind of middling along and not making it go so off the rails that it loses power. Like Erdogan is probably going to lose power because he actually took that country off the rails. But the Chinese government wants that economy to go further ahead. But more important than the country going further ahead is they want themselves to be the guys in charge as it goes further ahead. So I don't think the Chinese government will allow a debt crisis. If it does happen, it means that the CCP has lost control of that economy, and it will be a huge negative for Xi Jinping with regards to this year's effective election, where he gets his next term ratified by the Chinese Communist Party. Okay, and now comes Gary.
Okay, thanks, Viv. So Viv obviously, Viv has always been an analyst. It kind of falls to me now as a portfolio manager to try and make practical sense of how we're going to put that into action and give you guys really actionable steps that you can take on positioning your portfolio in 2022. We've heard now, we've kind of built our groundwork around the theory, so now let's get to the practical side of things. Okay, so the first idea that I have, and it's, I'm going to kind of talk you through how we do things. This is actually, so it's basically a basket of locally listed ETFs that you can put it in a discretionary stock portfolio. You can put it in a tax-free savings account. So this is actually the weightings that we're currently holding and the products that we're holding in our managed tax-free savings account. Like I said, we don't charge a management fee on this tax-free savings account. We do it all for free. And it really is a loss-leading product for us in that as long as you have a secondary product with us, we'll do your tax-free savings account for nothing. And this is essentially the weightings that we have. The way that we see it is these ETFs are kind of toggles. They're dials that we can then dial up and down depending on our macroeconomic views. So yes, we think that global markets are going to be under pressure, but I think it's going to still outperform, the local South African market particularly. That's why, while these are locally listed products, the majority of them are internationally focused. So you can see we've got the core share global property ETF. We have that sitting at about a 9% weighting. Again, last year I made property my set, if you want to call it, was my more speculative sector pick. Local property would have given you around 30%, but overseas, I think, global property is still very reasonably priced, even in a rising interest rate environment. So there is an opportunity there, and also it does give you asset class diversification. So one of the ways of building up this little mini portfolio that we're offering you here is to one, give you a diversification across different product houses. So you can see we've got core shares, Satrix, and Signia in there, but also across a couple of different asset classes. Now, like I said, this is the actual strategy that we're running inside the tax-free savings account. So you've got to also understand why the product was developed. It's technically, when you go into a tax-free savings account, one, you don't need to be Regulation 28 compliant. So that's why we can have such a high offshore exposure with a local product that gives you local tax savings. But at the same time, it also, there are other rules around there as well, but in that Regulation 28, at least, it is designed as an ultra long-term product. Remember, the best way to use a tax-free savings account is not to get the savings on interest, because the idea is that there'll be far more tax savings if you invest in your tax-free savings account and really hold it for 20, 30, 40 years. So it is a little bit more speculative in this, and that's why we are diversifying slightly across asset class to have the property, but the majority of this should be in equity. We're not putting any bond trackers or anything like that. We're actually skewing the other way to try and increase risk by holding something like the Fourth Industrial Revolution ETF by Signia. It puts a little bit additional risk. Now, this is the type of risk that you can adopt because it is because the portfolio is ultra long term. If it's a TFSA, it's also the way, even if you're buying this outside of a TFSA or outside of a living annuity, and you're buying it just with after tax money that you are going to pay capital gains tax on. Even then, the idea behind an ETF is that any switching that's done, within the underlying stocks is deferred until you eventually sell the product. So it's kind of quite tax neutral until you sell it. That can be a pro or a con. The other things that we have there, we've got obviously the S&P 500 ETF. So we kind of benchmark this against the MSCI World. MSCI World is actually more overweight the US. We have kind of gone slightly underweight the US, and we have quite a high European exposure at the moment. Like I said, we kind of was saying earlier that our expectation Europe versus the US, we think that the GDP growth in Europe might be a little bit better. But if you look at the actual stock prices, if you're talking in terms of the price earnings ratios, just as an example, Europe is a lot cheaper than the US. Part of the reason for that is the different makeup of the economy, or at least of the market. And the types of stocks that are listed in the likes of the UK, for example, are generally low P, more developed, more established businesses. It doesn't have the kind of ultra high tech exposure that the US has. But then again, if we are going into a high inflation environment, the idea of moving more towards those more mature value plays, I don't think is a bad idea, because one, they generally have high dividend yields, but which inside a tax-free savings account you're going to get a benefit from, because you're not going to pay dividend holdings tax at 20%. But at the same time, the low P stocks, as it says, when you look at your discount rate, when interest rates are low, you can go and look at growth stocks. You kind of are willing to accept cash in the future because you don't have any cost of carry. Whereas when you're looking at now, you're looking more at value stocks. And that's why I kind of like the idea of having slightly high European exposure. We've had that throughout this year. It's worked well for us in the specific ETF. I've got that kind of bonus pick written under the logo down at the bottom saying a large cap China ETF. So we do regular investment committee meetings with kind of everyone in the company. We sit together regularly, and it's usually every Thursday, and we sit down and we really kind of tear everything apart. What we did in our first investment meeting of 2022 is we decided that everyone in the meeting had to take almost a sectoral pick, or kind of play a theme for the year. My pick was large cap Chinese ETFs. And I think, yes, there's a lot of ructions going on in China. It's being hammered. But there's also a lot of reasons that China can come in those kind of little mini competitions where you're just playing for honor. There's no, it's speculative. So you generally do go with a higher risk option, but it is something that we might eventually introduce into this portfolio as well, maybe downweighting Europe. But as it stands, that's the current weightings and the current products that we're holding. It's a lovely little ETF portfolio if you want to go into it. As I said, we'll manage it for you for free inside a tax-free savings account. But it's also, if you are managing your own money and you just want to kind of look at a passive strategy, this is a lovely little passive strategy that you can apply. Obviously, think of it like we think of it as dials, and if you're running it yourself, we're not going to be turning the dials for you, but it should get you started at least. So that's kind of my first idea. The second idea is a structured product. So this is actually, the structured product is not open, and we're looking for them to reopen. As I said, in our structured product business, what we do is we build other products ourselves. We've got some incredible partners in Switzerland that do it for us, and we've got brilliant quant libraries, and we can price against basically, there's this one, like Etfs has also given us a wonderful system where we can kind of go and, any structured product that anyone delivers us, we can go and test it against all the issuers to see where the pricing is. We can do comparative pricing across, multiple providers now, and we can really build these things bespoke. So there's some incredible things we can do. The minimum on a bespoke structure, and I mean, if you are interested, is about $250,000. We've done quite a few of them now. And there you can really say, I want to link to this index. I want it to be an auto call. I wanted the observations to be at these points. And then you just ask us, what kind of coupon can I get for that? What we've ended up doing is a lot of yield enhancement products, because as many South Africans know, when they go internationally, you stick your money into an offshore bank account and there's no interest. And worse than that, with inflation where there is now, you might have a dollar-based account giving you maybe 1% if you're lucky, if you've really done well. But you've got US inflation at the moment sitting at 6.8%. We should be getting the inflation number out later today for December. And the estimate is for it to move to 7%. So as Viv was talking about, in real terms, so in inflation adjusted terms, if it does come in at 7% today, I mean, you're talking about losing 6% of your investment every year. The one thing that we have to stress, in a higher inflation world, which I think is what we're predicting today, you cannot sit in cash. Now, if you're sitting in cash and dollars overseas, what are you going to do with that? You don't want to go into stocks. Stocks could be potentially looking quite expensive. That's where we're advocating structures. We're doing the yield enhancement stuff that has heavy capital protection, but will still deliver maybe between a 4 and 10% dollar-based coupon annually. So those are some nice things. The one that I've got up here, though, is actually one that we picked up from Sanlam in December. And it says, okay, so it's a nice simple one if you don't understand structured products, just to get your head around what these products offer. So essentially what this product offered, it was offered 100% capital protection. So if you put 100,000 Rand, which was the minimum, into the product, even if the index, and it was linked to an ESG index called the Selective Index, even if that index collapses 80%, you get all your money back. The only way that you can lose money in a structured product like this, because it's a medium risk product, not a high risk product, is if the issuers, the person that is guaranteeing the product, goes underhand and has a credit event. That's the risk around the product. But as long as there's no credit event, and generally when we build structures, we use Citibank, or we generally use A-rated. So you think to the ratings agencies, we use A-rated banks. These are the kind of banks that if Citibank collapses, your stocks aren't safe, your structures aren't safe, your house isn't probably safe if Citibank collapses. It's one of the big 4 US banks. But the idea is that from a market movement point of view, you cannot lose money if there's 100% capital protection. Then what they were offering in the initial layout, and we kind of like had chatted to the guys that were pricing it, and they were saying, listen, they've left a lot of fat in this product, which they'll pass on to clients. So they started at 4 times the index. So if this ESG index in scenario 1 ends up 10%, you would have got 40% return for the period. Nice and simple, just a linear thing. If it ends up 30%, you're going to get 4 times that. You're going to get 400% the return. So if you invested in the direct underlying ESG index, you would have made 30%. But in this product, because you're adopting that credit risk, they'll give you 4 times that, and you'll end up at 120%. Obviously, scenario 3 is in a collapse. If it ends 30% down, you get your 100,000 back. They give you all your money back. So that's the product. I mean, they're awesome products. Now, we had chatted to the product house already, and they had said, listen, they've left a lot of fat in there. If it strikes at the current levels, they're actually going to give us, I think it's 7.1. Eh?
You give 7.
Yeah, so they gave us 7 times, so 700% return. So if this index only does 10%, you're going to get a 70% return. It was a Rand-based product.
Yeah, and the 12% tax rate.
At a 12% tax rate as well, because it was held inside a Sanlam endowment, because it was a Sanlam product. It's not currently available at the moment, but we are agitating to get the product relaunched. If they don't relaunch it, we will probably go and launch it ourselves as a bespoke structure. The issue with that is, remember, when you are taking Sanlam, in part, you're going to be taking on exposure against Sanlam, which is a South African insurer. So it doesn't quite have the same credit profile if we go to Citibank, which is going to give us slightly lower yields. But, for South Africans looking at it, we think, Sanlam, it's big, it's safe. And it is big and safe, so don't get me wrong, but it's not quite as big and safe as Citibank. So it gave a fantastic return. We put clients into it over December, and we are looking to relaunch the product. But if you're interested in these kind of products, it's something that comes up in the meeting often. It's all about TINA. And TINA, you ask, who is TINA? TINA is an acronym for there is no alternative. And unfortunately, in the environment that we're sitting in, where those stocks might be kind of muddling along, the worst thing you can do in a rising interest rate environment is hold bonds, because that is going to show proper capital drawdowns. You kind of want to go into the bond market when the rates have already moved up afterwards. You don't want to take that ride up holding bonds. And that's why these structures, which are kind of quasi-bond, quasi-equity hybrid products, offer some really cool returns for clients. So if you are interested, like I said, we can do them bespoke, and we can give you pricing and take you through it. And really, we'd like you to chat to one of our wealth managers about how to properly use them, because they are complex products. So we would prefer to have an advisor on the product, just to explain it to you, but I mean, we will take you through it in a lot of details, try and get you to understand it as well, but always nicer to do it in conjunction with someone that's looking at your overall portfolio. The third idea, of course, is our global managed equity portfolio. Basically long-term stocks, global equity stocks, I still think are going to outperform. This portfolio really represents the best ideas that we have at Rand Swiss. It's all the good companies. I mean, yes, they are equity ideas, so it's the best, the best equity ideas, because we do a lot of other things as well now that we do structures, etc. But yeah, it's all our favorite companies. And the move that we've been making recently is last year I had gone equal weight tech. We've started to trim again. We hold things like Nvidia, which with the chip shortage has just gone absolutely berserk. But we started moving into more conservative positions as well. So the likes of Procter and Gamble, we picked up General Motors this year as well at just sub $50. So that's kind of where we're starting to move from the growth side of the market, where we've had a heavy focus in the past, into more of a value market, because we do believe that the inflation picture, which we haven't felt in 10 to 15 years, we haven't had inflation like we're having at the moment, is going to change, not necessarily the overall profile of stocks. I know there's been a little bit negative on where indices will go, but as an equity basket as a whole, for me, it dramatically changes the sectors that you want to invest in. And you really need to start moving out of some of those growth stocks into some of the more traditional value stocks. And that's kind of the shift that we're making in the portfolio. Like I said, we're still not buying Zooms and that kind of stuff, but the likes of Microsoft, Google, still looking reasonable, even though they are tech players. So not selling them anytime soon. The quantitative methods that we use continually rank Google as one of the top stocks. So very comfortable to put that out as my offshore stock pick for the year in Google. Like I said, so in there we basically charge, at least we charge 1%. On that portfolio, very, very competitive compared to advisors, because we'll wrap their advice in there as well. You're not going to an advisor who's then putting you in the fund. We're getting you very, very close to the end product. It's probably, if you look at it in a full advisory relationship, it's probably at least 50% cheaper than you're getting. If you don't believe me, go let us show you in maths with one of our wealth planners, but pretty reasonably priced as a managed strategy. How have we done over time? Our portfolio, and I haven't got the risk metrics up for you, but I really should have put them up. So since inception, we're up 120% in dollars. So if you'd given us money in this portfolio 5 years ago, you would have doubled your money and then some, so you'd be up 120%. Think about that compared to any investments that you have at the moment and how they're performing. That is real performance after costs. Our benchmark is the MSCI World. It's up from the time we started this portfolio, like I said, just over 5 years ago. It's up about 90, call it, just about 93%. Kind of there's the period. So when we started it was actually kind of quite flat. The right-hand chart is basically giving you the space between the two charts on the left-hand side, just so you can kind of see, because this chart on the left isn't aggressively scaled like you sometimes see. And it's just showing you that there is a general long-term trend of outperformance. Every year, we're just taking a little bit more back from our index. which we're competing against, which is great, and we've managed to outperform, and it's been a great run over the last 5 years. The real thing in here as well, and I mean, you know, I'll share the metrics. I do a monthly presentation on this portfolio and the ideas and the kind of more, you know, day-to-day mechanics of what we're doing inside the portfolio. But really, it is the risk metrics. If you look at our portfolio in terms of volatility, compared to our benchmark, we are significantly lower, even if you compare it to some other products. For every unit of risk we're taking, we're generating a lot more performance, which is great. And then finally, I thought I'd give you guys a bonus, because we always kind of skip over local stuff. So I've put up so a lot of the guys that you'll deal with on a day-to-day basis at Ranswiss, the people that kind of make the company hum, people that you'll talk to, we've asked them all for stock picks. So this is not inside the investment committee. This is just a little bit of fun. And we're going to measure it from yesterday's closing price until the 31st of December. Everyone's picked a little mini portfolio. And in the mini portfolio, you know, whoever's got the best performance, I don't know, we'll make a bit of a rah-rah. But I thought I'd put up everyone's stock picks as well, so that you've actually got some tangible local stock picks if you are building a local portfolio to add to your portfolio. Maybe if you put them all together, you could have a nice little managed strategy. It could be your portfolio for the year. But like I said, these picks were also, they haven't gone through kind of like our deep dive methodology. It's people trying to maximize their gain over the next exactly 12 months. And of course, whenever you're buying equities, you really should have a 5-year view. I personally picked Nasdaq because, you know, down 20% last year. I'm very, very positive on a recovery in China. You'll see that with the FXI. I'm kind of banking that China's going to stop its self-harm. British American Tobacco, I'm then counting on the general public not stopping self-harm and continuing smoking and the next generation products. But really, British American Tobacco just very, very aggressively priced, and I think overdue a little bit of a re-rating. And even while we were a little bit negative on platinum and more constructive on gold, I'm going with Sibanye-Stillwater, and it's really about the quality of the management there. Even if we don't see a massive re-rating in the platinum price, the way that these guys mine has always been impressive to me. The other guys, when you phone them, when you speak to them on the phone, just remember their stock picks and give them a bit of hassles about how they're doing as well. It's, like I said, a little bit of fun. If you are interested in getting started with us, very, very simple. You can apply online. You literally go to www.ranswiss.com/account. All our products and services are up there. Click on the one you want. You can inquire and chat to one of our representatives. Or you can just go and fill in your mandate directly. Of course, we've got a FICA as well. We need the usual FICA documents. And then once your account's open, you really do have a single point of contact through our treasury service to deploy capital in South Africa, internationally, into a multitude of different assets and asset classes at varying levels of service. We've really done everything that we can to make it as the investment journey as simple and easy as possible for you. So prize giving, okay, so what you got right and what you got wrong, but prize giving, yeah. So basically, these are the questions that we asked in 2021. As I said, the lead stock picker was actually Charles McLeod. I don't know if he's on the call at the moment. So he's going to get one of these little gift packs sent across to him. But we'll contact Charles if you are watching. Well done. Great calls and just very good. But we'll be in touch to arrange delivery. And please go back to the link that was in the beginning of the presentation. I'll put it up. We'll email it around with the thing and fill in your questionnaire. Next year, you might get a gift basket. Like I said, if we do better next year, maybe we'll make nice surprises. But thank you, everyone, for watching. We really appreciate your support. That takes us just past the hour. So as I said, we are going to stay on for Q&A. And we
have quite a few.
Yeah, we've got quite a few to chew through. So let me stop sharing the screen so that you can see us. And let's start hitting the questions. Okay, where do you want to start first? So
the top list.
Okay, we've got a lot of questions. I don't know if we're going to be able to get to all questions, but let's start at the top. Okay. Will semiconductors outperform the S&P 500? What do you reckon?
But depending on what you talk about, semiconductor companies, look, they do have a supply shortage at the moment, and that's obviously even positive, but that's going to, the market, I think, does understand that's going to be coming into play. So I don't think it will. I don't think there'll be like a super market for semiconductors out there. It might slightly outperform, but it won't be oh, this is the next gold rush.
Yeah, so it depends also on the time horizon. So for me, semiconductors, I mean, if you look at the chip makers specifically, like again, once you drill into the semiconductor market, there's a lot going on. And, the semiconductor shortage is expected to remain with us until well into 2023. And I suppose the pricing reaction that we've seen in the semiconductor market so far, or at least in the big names like Nvidia, AMD, Taiwan Semiconductors, Broadcom, has been incredibly positive for those share prices. It's great when there's so much demand that you can't supply it. But the other problem is also that when you have such a high demand for yes, a complex instrument, it is very difficult to create a semiconductor factory. I mean, the sterile environments that have to be created, the institutional knowledge that it takes to create an effective chip is difficult. But at the same time, you have big other tech players, the likes of Apple, etc., creating their own chips, Samsung looking at chips. And that kind of manufacturing capacity, you get the sense that humans, we only get caught out once. When fool us once, shame on you, fool me twice, shame on me. So essentially what's going to happen is the auto manufacturers are looking at how they're going to be able to source chips. They don't want to not be able to sell cars because they can't put chips into their cars. So I think the idea that the expertise and the supply will catch up is definitely going to happen. Will it happen in the next 2-3 years? Markets look forward 2 or 3 years. So I don't know how much is already baked into the price. We've kind of trimmed our Nvidia position slightly, but we are looking at actually adding AMD as just a diversifying factor, because Nvidia became, through the incredible growth that we've seen over the last couple of years, it became 10% of the portfolio. So we had to just trim it back just from a risk point of view. But yeah, I think that's semiconductors. This one's for you. Mm-hmm. Will Cyril win the second term as ANC president?
I think it's quite likely. I mean, the ANC is falling down, and I don't think it's even the stalwarts of the ANC believe that they will win more seats without Cyril there. And I think if they do remove Cyril, put like a Sisulu or a like Ace or someone in there, I don't think that'll be viewed as a smart move. It's one thing to be like, 70% up and then put somebody else in place. It's another thing to be in the 50s and then the guy that basically is one of the more popular politicians in the country is removed for someone that's not as popular. It will have an impact on your actual election results.
Okay, so how will the ETF market perform in 2022? So that's an interesting question. Yeah, so remember, ETFs track many different markets. So it really depends on the types of ETFs that you're looking at, because they will track the underlying market performance. But I don't know, maybe if we expand that question to say, are ETFs still like an incredibly popular product? And will we see more flows into ETFs? I think ETFs, they're a wonderful tool in financial markets. As you can see from this presentation, I mean, we use ETFs as part of our managed strategies as well, because there are so many ultra low cost ETFs that it allows you to express a view in financial markets in a very simple, very effective manner. At the same time, I do think that there are new products that are coming on stream as well. And I think that, as much as we said, maybe not Bitcoin, the question was going to be, but then it was too vague. Is Bitcoin going to be $100,000 or $100,000 or rand? Where is Bitcoin going to go? I think there's big disruption coming from blockchain technology. I think there's also the likes of structured products as well. I think there are very innovative new financial products that might grab the retail investors' attention and maybe take some flow away from ETFs. But generally, ETFs, awesome products. I don't see them going anywhere in 2022 other than probably more inflows into it. Passive is a very popular way of investing. Will MSCI World outperform DSP?
S&P.
S&P. Will MSCI World outperform S&P?
First of all,
was that one of our questions?
Yeah, I think we did Nasdaq S&P we talked about.
We don't.
Okay. And one thing you got to understand is that the MSCI World and the S&P, there's like a 2/3 correlation, because the S&P is 2/3 of the MSCI World. It's ridiculously how much the rest of the world is is half of what the S&P is effectively in the MSCI World. The MSCI World is like 2/3 US and the S&P is most of the US. So yes, I do suspect that we might see the MSCIs recover a little bit. I think, like I said, if we believe China, which is a big chunk of it, and Europe is also a big chunk of it, do reasonably well, there's a chance it might occur. But remember, if you do buy the MSCI World, you are buying mostly US anyway.
Okay. Yeah, so that's actually an interesting point. So it's one of the ways that we create the yield enhancing products as well in the structures. So because there's a high correlation between the likes of MSCI World, even the developed markets, which don't have a direct overlap, which is what we're talking about, but you often see the US market tracking very closely to the Euro, let's say the Eurozone and the UK. So what we can do is we can also do what's called a worst of structure for you, where we put in those three indices that are high correlation, and as long as the worst one is positive, you can get quite an excessive return. But because of the high correlation between the indices, you actually get quite good pricing, even though it should be more risky than it is. So that's a way that you can kind of generate some nice yield enhancement product. And there's also some crazy things the guys in Switzerland are showing us about, going long correlation, short volatility, but you can chat to us about that. That's, I think, a bit outside the thing. What is your view on the Fang stocks in 2022? Okay, so the Fang stocks, again, it depends which Fang stocks. Go with different views on different letters in the Fang in the Fang name. Like I say, Google is probably my offshore stock pick of the year. Like you look at the quants on Google, you look at what Google's doing. I think it's got a pretty unassailable position just in terms of IP and in terms of cash, in terms of positioning, and in terms of entrenchment in its market. There's so many good things about Google. So Google, great. Netflix, I mean, I've kind of preferred, I kind of put out the view this year that, like, I think Disney will outperform Netflix over the next 5 years, just because in one way you're playing like a return to work. Because as those parks open up, which is still a big segment of Disney's revenue, I think it will do better than Netflix. At the same time, you look at the quality of what Netflix has done and the massive momentum the stock has. I definitely wouldn't say Netflix is a bad company, and I've thought about going, because Disney's a very different prospect. Even though you have Disney Plus in there, which is the direct competitor to Netflix. The parks business is so different. And I mean, they've got strong franchises in that, but I kind of almost thought maybe we should just spread into Netflix and Disney and kind of capture more of the streaming market. You've got Amazon, Disney, and Netflix. You've got just about all of streaming, I suppose. But Amazon, I mean, our view on Amazon is got a long runway ahead of it. The retail, the ability to capture retail market share for an online retailer like Amazon, I think it's still the tip of the iceberg. Even at the size Amazon is, Amazon can still get a lot bigger. Amazon can get a lot bigger than mobile phones can get, than advertising can get, just because of the nature of the beast that it could swallow in Walmart, for example. So I think Amazon, I'm also like, pretty happy with. Facebook, or now called Meta. I don't know if we're going to call it the Mang stocks now. So Facebook,
it should be minor actually, because Google's the alphabet.
Yeah, Google. I don't know what's the other A. Is that alphabet?
Apple, Amazon, Netflix,
Apple,
Google.
Yeah. Okay, so they're still calling it Google. Okay, so I'm still calling them Fangs for now. But yeah, so like with Facebook and Meta, it's there's been incredible performance there, but we held Facebook for a long time. We've taken a lot of a run up on Facebook, but after the Cambridge Analytica debacle, we've kind of taken a step back. Also, we had to make a call because they're both targeting the same, essentially the same segment of the market. The majority of the revenue is coming from advertising. I think there's some I'm sure we'll expand on it, but very exciting things that they're doing in VR. And I think VR is going to be very key for Facebook. So I'm not saying don't own Facebook or don't own Meta. It's just we were kind of doubled up. I wouldn't own Facebook and Google at the same time. Just because their revenue streams should be quite correlated to online ad spend and marketing spend, or digital marketing spend, if you want to put it that way. But no, we don't personally own it. Maybe it's an ethical thing. Maybe I just don't like Facebook.
Oh, so look, I mean, a couple of things here. Firstly, the one concern I have about a couple of these companies is the fact that, look at Microsoft. I mean, those of you that are old enough to remember, when basically the whole tech internet revolution is happening, where we started, like, before even cell phones, before we had all the kind of stuff we have right now, Microsoft dominated and absolutely was by far the largest tech company in the world, right? And if you had to say at that point in time, looking forward 10, 20 years, who's going to be the one company that dominates this new, if someone told you, okay, I know for a fact, tech is going to be this big in the year 2020, 2022, this many trillions of dollars, which is the company that's going to make the biggest, chunk of that? You would have thought Microsoft, because Microsoft had by far the biggest, pot of money and so on. What stopped Microsoft from doing that was they were under investigation by the US government for its monopoly practices. And what they effectively did was they had we had auditors effectively coming in from the government and being involved in Microsoft's product issues. So if Microsoft wanted to make a new product, it had to be approved by the Department of Justice before they could do that product. Effectively, it killed growth in that company until the whole Steve Ballmer administration was destroyed, because he could not do anything new for the start. And then, he got to like complacent and he never did much afterwards. Satya Nadella came into place more recently, and he's basically gotten that company going up, dramatically because of the ability to go and do things like cloud and so on. And so Microsoft had like a period of over a decade where it was just basically doing nothing because of government investigation. What Gary was mentioning about the Cambridge Analytica stuff was the fact that Facebook is now facing this kind of regulatory scrutiny. You've already had Facebook whistleblowers coming out and saying that, hey, looking at Facebook is bad for little girls, which is true. If you have any female children, do not put them on Facebook. Every single study out there says that more time spent on social media for a young girl especially increases the chances of terrible things like suicide, which is not a minor effect, not like bad impression, but just actual killing themselves is a possibility. So Facebook's probably going to face this regulatory issues. Amazon, to a certain extent, is almost skipping over it, but it still faces regulatory issues, especially against Republicans, because Jeff Bezos owns the Washington Post. The Washington Post is very pro-democratic and anti-Republican, especially anti-Trump rather, and that might be a negative thing for them, because Trump, which right now, quite frankly, if you look at the betting markets for the 2024 elections, by far, not talking about like a close margin, by far, the number one leading candidate is Trump to win that election. If Trump basically ran in 2024, he was still alive and functioning when he's in his 70s now, close to 80 then, or I think even over 80 by then, if he's still functioning, he'll probably win that election according to betting markets right now. Then you have a huge negative against maybe Amazon if there's a DOJ kind of situation. If I was looking at Fang, the two companies I'd look for is Alphabet, which is Google, and Microsoft. Those are about two probably picks in the Fang sector.
Cool. Which sectors will do good, or will share prices drop significantly? Okay, so I think we covered that in the presentation, but also just I think the idea that you're going to go through like a total market crash, always just be nervous. Whenever you read the market is going to fall out, remember, market is a future prediction of what's going to happen. Generally, market crashes happen in panic. It's unknown unknowns. It's something that like no one is going to be able to predict. So when people are predicting big share price drops, you're probably dealing with someone that is not entirely above board. It's probably more of a more of a fly-by-night operation. Will passive managers do better than active managers? Well, I think traditionally they probably do. Again, it depends what kind of passive. So the problem that you're facing in historically,
but also it's about the average, a function, right? The best active managers tend to do a lot better than the average. But the thing is that the average basically is going to be, let's just say the average is 50, okay? You'll have a couple of guys doing 100, 200, right? So the number of people that basically do 200 is going to be quite small. The people that do less than 50 is going to be larger than that number. The average is going to be 50. And so just by a function of mathematics, the number of people that beat the passive market is going to be smaller than the number of people that don't beat the passive market, just because the skew is going to be to the higher end.
So that's one thing as well. So, but I suppose also the idea, and it's an idea very prevalent in retail markets, is that the ETF is kind of like the product. It's a safe product. You can just do that. You'll always do better if you buy the ETF. Like I did a great show on 702 with Bruce Whitfield around where we did the dark side of ETFs. If you can get the podcast, I mean, I kind of really went into a lot of detail about the little funnies that you find inside ETFs. But I suppose the other problem is like which ETF and which passive manager. ETFs and passive managers, I'm using it almost synonymously. They're not synonymous either. But passive management, there's so many different forms of it. I mean, even inside that little portfolio that we built for you, there's even at Signia, there are two S&P 500 trackers. One is going to charge you almost 1%, and one is going to charge you, like under 20 basis points. So, or around 20 basis points. So there's a big pricing difference from the same product provider on the same index. So there's a lot of work that you actually need to do just because of the massive explosion in passive products. Because not all passive products are created equal. I mean, the worst of the marijuana stocks that went through a craze a while ago, there were so many, you can buy this ETF that will track, the cannabis theme. And you go and look in there, and it's a company that has, maybe it supplies fertilizer to farming, and maybe 3 farms of their 10,000 customers are cannabis farms. It's in the ETF. You're not really playing the right themes. And it just becomes this hypey, environment where they're just trying to sell you stuff because retail investors will bypass it because they've heard it's a good thing to buy. And as the volume of products has exploded, you need to take a much more critical eye to the passive market as well. So I suppose that's the other kind of word of warning that I just issue around just going directly into passive, but the same is applicable of active managers as well. Know who's managing your money. Understand the people that are behind the product. Don't just buy the brand name or that. You want to understand the strategy of the product. You understand the fees. You want to understand the people that you're working with that are managing your money.
Just like one point with passive, right? I mean, most people that do passive don't understand the difference between an ETN and an ETF. Sure. If you want to go and basically invest in an ETF, it's by far much safer than an ETN. The ETN is an exchange traded note where you take the credit risk of the issuer. ETF, there is actual stuff out there that belongs to you in theory. So for instance, if there's the ETN out there and the institution that you basically have the ETN with has a credit issue, that note becomes less valuable. ETF is not as dependent on that. Obviously, there are still issues, but they're not as dependent. And just that kind of knowledge, just a little bit of knowledge and looking into what the actual fund is, it matters. Not just saying, okay, passive, and I'm just buying some ETF/ETNs, whatever it may be.
Absolutely. Okay, so the next one, will developed markets outperform emerging markets from idea one? So this was a question last year. I don't think we did the question this year. So again, I do believe that emerging markets will come back in a big way. Maybe not this year, though. It's so difficult to tell. I think one of the reasons I didn't include it now, and we are still heavily overweight developed markets, is that given the COVID pandemic and the response that developed markets with bigger, I suppose, spending programs and the ability to push through bigger spending programs has, I think those economies are in a little bit better shape than emerging markets. That said, I'm still very, very optimistic on emerging markets. One, because the demographics are generally in favor of emerging markets compared to developed markets. And I told a story last year about basically it was a UK analyst that I used to know that was out here working in South Africa. And I was like, oh, don't you want to go work in the city again? I mean, isn't it? And she was telling me, like, this is the most amazing place to work. It's a frontier market. This is where all the excitement is. That was in 2008. The whole idea of emerging markets versus developed markets has changed. And back then, I mean, you were crazy to go and invest in a developed market. But I think with the technological advantages that they have at the moment, with I suppose the other theme that we haven't talked about is just the
reverse globalization.
Yeah, the reverse globalization, the way that borders are literally shutting down. The problems, when I say problems, like in the vertical, please don't think I don't have a problem with immigrants. But, you know what I mean? The problems with immigration and the xenophobia that goes around it. I think developed markets are going to look far more inwardly at their economies. And that will also just hinder emerging markets in the shorter term. But longer term, I mean, the population, you can't fight demographics. And I think that's why, our very ultra long-term view is I don't know, we kind of see Africa as this big, exciting option, that could pan out incredibly well or incredibly badly. And if it pans out well, it will pan out so well, it'll be multiple times better than anything else you could have invested in. But,
we're talking like a multi-decade view.
A long-term view, but it's something that we often do discuss. So we like emerging markets, but I think this year, like if we had to go and actually bet on it for the quiz, I'm probably going to say I think developed markets are probably.
With one exception is China. So if you look at China as the emerging market, you might say that emerging market in China might do better than some of the developed markets, for instance, in Europe. But if you're looking at places like in Africa, you're looking at South America and so on, I would be more positive about the developed markets, even in Europe or North America. But China might be the one exception.
Okay, I don't know if you want to take that. Okay, so I'm just going to answer the second. You can look at the first one, but like the second part of the next question is, if you don't mind me asking, why the Core Shares Global Property ETF and not the Signia ITRIX Global Property ETF? We already have 3 Signia products inside there, and like I said, we like to. It's not just about diversification in asset class. We like to diversify across product houses as well. For many reasons, it's good to have not all your eggs in one basket. But I don't know if you want to answer the first one. But
okay, so okay, look, I mean, truth be known, until like
this is what effect could, if you can't see the question, what effect could the reported insurgency in Mozambique have on South Africa? We sent troops there mid-2021.
Okay, look, I mean, here's the thing. I mean, until like last year, July, June, we had the riots in Durban. I thought we were pretty strong from a security point of view, at least in that level. The mishandling of that particular thing was quite concerning. It is possible that violence does occur in our neighbors and that does spill over to us in South Africa. We've had seen things in the smaller places like Lesotho and so on occur. And of course, they're much too small to have an effect on us. But a large insurgency based in Mozambique could have a massive impact on us, especially if there's a refugee crisis, especially if there's the impact of instability and cross-border kind of issues happening. Until now, we're just so much more technologically advanced than our neighbors. Our economy is much larger that our ability to basically stand up to any of them is quite large. But I mean, I think the major thing of like an insurgency or an issue like that will be the fact that we would have a massive refugee crisis in the country, which would be something that is quite difficult to handle. Look at what happened to the Zimbabweans. And you may not see it as a major crisis, but I mean, look at people like Herman Mashaba and so on, and the rhetoric he has and about immigrants. And I think that would be also just dialed up because of that.
Okay, so sorry, guys, we're going to have to call it, but there's so many more questions.
We've still done the Q&A as well. We've done the Q&A.
Yeah, we haven't even done the Q&A. So sorry, guys, there's a ton of stuff still coming. I'm just going to kind of try and pick a few here. You seem to have missed your top sector pick for 2022 on the JSE, where your prior pick was telecoms. Oh yeah, I suppose. Well, no, I didn't do a JSE one. I did the FXI, which was China, is my kind of sector. But I think I made a sector pick. I mean, what do we think is going to do well this year? I mean, the telcos were just so crazy. I mean, we've been so positive on. I only have ever been negative on Vodacom.
Yeah, I mean, this last question, Eldrick one. I mean, there's a number of big listings happening in South Africa in the next year. Mostly of companies that are splitting up or currently existing companies. The Coca-Cola listing is one of them here. There's a couple others as well that are significant in the context of our environment, which might be a slight reversal. But I mean, you really don't want to be seeing only these big, split ups and that creating, new listings in the country. You want to see actual, like a Facebook example, small startup that goes up and becomes a listed company. Will Coca-Cola list this year? I think the expectation it will list this year.
Maybe.
Okay, let's just do the Q&A.
Yeah, we can do the Q&A. Yeah, so sector pick. Yeah, I'm just going to put. I'll do industrials. It was only 16% last year, but this year industrials is my pick. We can go and have a look at it next year. Cool. We're just going to run through the Q&A.
Do you think we'll have a distant pullback this year on the JSE? Not unless there's a crisis. Now, 20% pullback would be. Means it would be quite significant. I don't think that would be likely unless there's a crisis.
So what, 20% pullback? I mean, that's a proper bear market. That's on average once every 5 years or so. So
yeah, but it's so negative. I mean, the global market hasn't done it for a while.
Yeah. So also difficult to say, difficult to predict big drawdowns on stocks because they generally come from unknowns. So to try and put a time frame to say now, and I mean the JSE is not expensive. I think top 40 is sitting on about a 9 price earnings with a 4% dividend yield. I mean, I'm not saying you can't crash to sort of like a 7 PE, but I mean, yes, I mean, maybe if there's a big shock, it depends. I mean, listen, South Africa is a tough place to operate in, but as Viv said earlier, like so many of our stocks are also global stocks as well.
Okay, the next one, property markets are looking very long term. We're not talking about 10 to 20 year outlook, right, for property markets. The question is, what's your property outview for local and globally over the next 5 to 10 years? I'm saying 10 years plus. Demographics are against you in the property market. You may not realize this, but there's most of the places in the world, especially places that have really big property markets, they have below replacement birth rates. Okay, That means over time, you're going to find fewer people going to cities because that's where the young go. More people going to the outlying areas where their property is cheaper, retire in the countryside effectively. So for a longer outlook, I would say that look at demographics. That's maybe not a 5 to 10 year outlook, but a 10-year plus outlook. Look at demographics, and you're going to find that a lot of places look that there's going to be a lot less people, and a lot less people is going to mean a lot less movement up in property prices because there's less demand.
Yeah, and I think also, like, when we're looking at property in general, I mean, I know we've got a small property exposure, and it really is asset class diversification in that ETF portfolio. But when we look at direct stocks in property, I mean, the kind of stocks that we own remember, we run personal share portfolios inside RAs on the local market. And that's, that South African fund. I mean, we own storage, we own kind of very speciality REITs. In offshore portfolio, we own something called Equinix, which is one of the big, there's the world's largest data center property REIT. So you're looking for ways of playing property that are adding more value than just property ownership alone. And that's where you're going to get the margin. So that's kind of where I think that the right way to invest in property would be, rather than just going and buying office and saying, oh, well, people are going to rent offices, let's get our yield, it's nice and safe. I think if anything, the pandemic has taught us that, that it isn't safe. Okay, Natalie, how will possible military aggression by Russia affect markets?
Oil prices. You'd be looking for the oil price sector. Oil prices to be the thing, and obviously oil prices translating to inflation as well, and of course interest rates and associated factor, and maybe gold. Gold might also be a thing that people are going to be looking at. Also, if Russia really has a real kickback, Russian oligarchs, the Russian money would have to flow somewhere. So you might just find, speaking of property, an uptick, because a lot of stuff that the Russians and the Chinese have been doing. One of the reasons we've had massive increases in prices in places like London and New York is because rich people in China and in Russia and other parts of the world where they are scared of the local government tend to park their money into overseas real estate because they consider that to be a safe place to leave the money. The next question is how do you allocate funds long-term? Pure equity portfolio.
Personal, yeah.
I would say as much into, let's say 75% local versus global, or 75-25 or 50-50. I would say as high overseas as you can get.
But yeah, I just qualify that as well. Just say, like, I mean, it really depends on the person as well, and it depends how you're doing it. It depends, so much of it, like if you're below 55, so much of your compulsory money is going to be stuck in South African markets anyway. So if you have a large kind of retirement pool, everything that is discretionary money, yes, I would say ship that overseas as much as you can. Why buy a stock portfolio locally without having some sort of tax incentive around it? At the same time, if you're talking about someone who's 60 years old, that is planning on living in South Africa for the rest of their lives, has total freedom on where they can deploy their capital, I definitely wouldn't say 100% overseas, because they've got local constraints as well. It's a very personal question. That kind of, almost a tactical split, I would say, speak to one of our wealth managers, and they'll be happy to take you through, because they'll look at your personal situation and then make a call based on inputs that are not general inputs. But yeah, I think, like, if we were just doing it on performance, higher offshore at the moment.
But this way, like, I mean, our South African financial sector is less than 0.5%, like 1% of the world's financial sector. We have most of the growth in financial markets come from innovation. We have skipped that over. We're not going to get that in South Africa. So from a pure, point of view, where would you put your money? Probably overseas. But Gary is right. If you're looking at income from it, you might want to be looking more towards the local market as well. Not as a majority, but having a slightly more than 1% allocation in the local market.
Cool. And then the last question, which I'm going to call, is like, will you send a link of the recording? I missed the first 20 minutes. Absolutely. So the marketing guys will send around in the next couple of days. So if you've registered for the presentation, we'll stick it up on YouTube under a link, and you guys can watch it and hopefully enjoy. If you do have any further questions, or you want to chat to us directly, I mean, please just drop us an email, contact us. I mean, we're always happy to chat as much as time will allow. It's been a bit of a fast start to 2022, but I hope everyone enjoyed it. If you're not a client, come and be a client and then vote for us in the awards. Yeah. We do this really for the love of markets and the jobs. So yeah, if you enjoyed it, please come and give us a thumbs up and come and support Transfers.
Thanks.
Thanks a lot, everyone. We'll chat again soon.